Welcome. This is Tommy Ruke, and this is part one of a four-part. If you have any questions during this program, please type in the chat window on the right-hand side of your program to let us know if you have questions. We will try to answer them during the program, but if for some reason we don't have time, then we will send you an email and share it with everybody else afterwards. If you have problems with the program, or hearing my speaking and or seeing the PowerPoint, please call our office at 800-741-4084, or also type into the chat window. So let's get started. We're going to look at intermarine coverages, but before I do that, I want to look at the insurer's location, because that's what we start with, is covering what is at their location, and then we use intermarine to cover the exposures that are not covered under the basic policy. My first question I ask you, how many of you all go to Google Earth to find out exactly what is at the insurer's location? It's my strong recommendation that you do that in all cases so that you can see what we are looking at the insured's location. What we'll find there that we want to think about is the property at that location and the coverage it might need. What are the operations there that might require some additional coverages, and or what is the exposures for property away from the insured's premises, both owned or not owned. We'll look at the real property. The real property are the offices, the garage, the loading dock, storage warehouse, or storage facilities, or warehouses. The operations that might create concern is how much parking space they do. Do they let owner-operators vehicles park on the location? Do they have fueling facilities that might require coverage for underground storage tanks and pollution coverage in case that's not done? What are their washing facilities, and how well are they disposing of the water that is used to wash the vehicles? Is it just a payroll and dispatch office where you don't have any activities there as far as loading and unloading or cross-docking or parking of the vehicles? And also, do we have the drivers that are insured testing coming to taking a road test before they hire? All these things will be at that location, and Google Earth should show you the facilities, how much space is there, and what these are as we go through here. Now let's talk about the property, because this is what we're basically talking about, is starting with the basic property coverage and then building on intermarine exposures. The first question, who owns the property? Since we've been in Insurance 101, I have been told to try to maximize your protection of the assets first by making sure you have not exposed all the assets of an insured in any one entity. The major cause of a catastrophic loss to an insured is their auto exposures involving in the motor carrier's business. If your insureds have real property, have buildings, have loading docks, have facilities, it's recommended by most people to move that property into another legal entity, meaning not owned by the insured. So the first thing you have to do is find out who owns the property. You have to be real careful for small businesses and small corporations, because what they'll tell you is that I own it, and you have to ask your insured the question, who is the I? The I being the owner of the corporation, LLC, the business, or I being I own it personally. Most of the time when you deal with lawyers, it would be suggested that you put it into a trust or own it personally. In this case, the owner of the corporation, the owner of the motor carrier, would have control of those things. So you have legal control. But let me suggest when you do this, and this is ignored by a lot of people, you must have a lease. Have a lease between the two parties, even though they're owned and controlled by the same people. What you'll hear the term is trip net lease. Trip net lease says that the lessee, which is the operating entity, will be responsible for taxes, insurance, and maintenance. That's what trip net means. And that facility, that needs to be spelled out so that motor carrier has that obligation to maintain the facility, to insure the facility, which will give them insurable interest in the insurance coverages, and of course taxes will be paid. You also would want to have in that lease a cancellation provision where it does not get canceled for any time of demise of the property on the building, or excuse me, on the location, because you want the rent to continue beyond that. But you might want to look at that part of it. Now that trustee will be a landlord too, so during the lease you want to include a waiver of subrogation. The policies allow you to waive subrogations. All policies, auto liability, general liability, and property, allow you to waive subrogation before any injury to the property happens. This will reduce the insurer's responsibility for having exposure in case they burn down the building because of welding and not welding it properly or things like that. The insurance carrier could come back and waive and seek contribution from the insured for their negligence damaging the property that is being insured by the insurance carrier, and you want to have that waiver, and you want to have that waiver subrogation negotiated in the lease whenever possible. So the first thing you do is who owns the property there and how we style the policies, and we're not going to get into that now. That'll be another subject somewhere else. The policy that we'll write most of this business is the commercial package policy, with the property coverage part of what we'll address. That policy addresses three certain situations: the building itself, the business person property, the property owned by the business, both owned and property of others, and then you would look at the property not covered as we consider what is being provided by the basic coverage and what additional coverages we might need in the marine format. When you look at the policy, you want to set up the limits. The limit should be the value of the property that we're trying to insure. It will most often be replacement cost. That's the standard carrier coverage, unless it's an older facility or you're dealing with insurance companies who are not doing the mainline business. You might have to buy coverage agreed at the ACV, actual cash value, which would be the depreciated value of it, not the replacement value. But the limits must represent the replacement value. You would have a co-insurance obligation. I get frustrated when I hear insurance providers or insurance people talk about the co-insurance being a penalty. It's not a penalty. It recognizes that most losses are not total losses. Most losses are small losses. It recognizes that the higher the limit is, the better, more premium you get, yet that will not happen. The total loss will happen more than 2 or 3% of the time. So there'll be a co-insurance part of it. Standard ISO has an 80% co-insurance that is the zero rate adjustments up or down. I recommend a higher schedule there. I recommend 100%, but ask the insurance company to give you an agreed value endorsement. The agreed value does not agree to the value of the property. The agreed value agrees that this amount of coverage that we have will meet the co-insurance requirement. Therefore, as long as we're carrying this amount of coverage, we will not have any co-insurance penalty at time of loss. Some insurance companies have reluctance to do that, but insurance companies, I recommend you doing that for two reasons. One, it clears up this bad area. It most often will get you a higher limit. But second, the insurer has to file a proof, a statement of values that you get to look at, so you can check and make sure the limits are high enough. I also recommend, whenever possible, to blanket the building, particularly the alterations of the buildings, because there's a gray area between what is building and what is property. Again, this does create a 5% increase in the premium, but it saves adjustment time when a loss happens. These things you want to look at, but I would recommend you blanket the building, business personal property, and the property of others that be covered in the building. Most often also you'll write the special cause of loss, which basically says everything's covered unless excluded. So look at setting up the policy. Here's the wording in the policy that I want to focus on today, and we're going to touch a couple of highlights as it deals with motor carriers. It says covered property as used in this product means the type of property described in Section A and limited A1 and limited by A2. Building means the building of structure. It also includes complete operations, fixtures, including outdoor fixtures, permanently installed machinery and equipment. And that's the concern I have here, because when you ask the insured what kind of limits they want for the building, they're thinking of the four walls. But the form says, and the form gives us coverage and calls building. Look at a garage. If your insureds have a garage, do they have permanently installed air compressors? Do they have permanently installed abilities to dispense grease and oil? Do they have some of the lifts that are there permanently installed to raise and lower the equipment? All those things are defined as building, and therefore the limit of those items must be included in the building limit, or at time of loss you might not have enough limits to cover it because you cannot use personal property limits to pay for a building loss unless you blanket it, and that's another advantage of blanketing it, and you can have a co-insurance problem. You have the personal property. Appliances used for refrigeration, cooking, laundry. Those things also are building. The insured understanding of what is covered. The items defined as building must be included in the building limit. So you need to go back and look at those things to determine what is building. And again, I suggest that you have the counters in the dispatch office, you have the machinery that maybe is in the garage areas or other kind of areas that you would have to consider in the building limit. In other words, read that and discuss that with insured before you talk about the limits of coverage you need. The second area you have is your business personal property. You mean the named insured on the policy, which is motor carrier. Consistent of the following property located in or on the building or in structures described in the declaration or in the open or in a vehicle within 100 feet of the building or structure, or within 100 feet of the premises described in the declaration. First thing about that is when you describe the location, it's not within the building, it's in the lot line. It's within 100 feet outside the fenced area. That is not just within the building. And it includes furniture and fixtures, machinery and equipment, and stock. There are other things, but these are the things that are important here. So let's talk about the significance of that now, looking at a motor carrier's location and see what we have in these areas that might cause us problems as we address the limits and coverage that our insured needs. In open or in vehicle, with 100 feet of described premise, 100 feet outside of the lot line. Do you have insurance? I have not been in a trucking location ever that the insurer doesn't have something they call the boneyard, the salvage yard. They have equipment out there that they use. It could be wheels, tires, old transmissions, old engines, parts out there. They hoard those things because they think they could be used later. Well, all that is insured as personal property. Most insured have no desire to insure those items out there. However, since they have value and they meet the definition of covered property, you must address that in the limits of coverage and have an understanding of both the insured and, more important, the insurance company, that we're not insuring those items. Those items are just there for salvage purposes. The insured wants no coverage on those items. If you don't do that, then you can have a co-insurance violation. I have an insured that some of you have been in my classes. My favorite insured was my beer distributor that I insured for many, many years. The way that they did their inventory is the driver came in every day with their truck. They give the loading people responsible to the warehousing the sales slips of what they sold, and they gave them return what was unsold, and then gave them loading instructions for the next day. The warehouse people loaded the truck and then moved the truck outside the building, but within the location, within 100 feet of the premises. From a practical matter, once their records are shown that they show those items sold to the and no longer in inventory. So if you checked in inventory at the end of a business day, it would not show the property in the trucks outside the fences. This is important if you're insured on some kind of reporting form basis, where at the end of the month they must report 100% of all the value of covered property. You have to consider those things outside the property. So the concern must include all those items or get an agreed value, obviously, that would do that. Personal property of others, that's in or care. We cover the personal property of others, but it must have a separate limit for personal property of others. And so that would cover some of your insurance bailee responsibility, both in the warehousing and also in the cargo situations that you would want to look at. So is there coverage on the basic policy for some of the items that later you insured as a for-hire motor carrier might be responsible for on the basic policies? So consideration. must have the limits in the deck or included in the blanket if you want coverage for those items. Coverage will address customer property as well as employees or owners. Without a limit of property of others, there is a covered extension for personal property of others for $25,000, but that does not include theft. I did mention the concern about your insurers, if they're motor carriers, legal liability for property of others, but there's also a consideration how many of your insurers might have an employee who's a mechanic, and the mechanic has their tool set. The mechanic has their toolbox. Some of those mechanic tools at all, in fact, whether you're insured knows or not, they probably paid for it with a snap-on tool from the snap-on tool person. That's property of others that benefits your insured. So the mechanic has a difficult time covering those items himself or herself because it's business personal property. It's not easily done in homeowners. They don't have the cost in their budget to insure it on a separate inland marine coverage. Yet if those items got destroyed, your mechanic would not have the tools to do the work on your insurance behalf. So therefore, it's a good thing to think about those items and see if we are covering those or should cover those in the basic policy. My recommendation is to do that because I consider those mechanical tools to be a benefit to the motor carrier, and if the mechanics didn't have it, the motor carrier would have to facilitate an ability to have those replaced to make the mechanic useful to them. Let's talk about these items that we discussed earlier in the furniture and fixtures and machinery and equipment. Again, is your computer furniture and fixtures? Is the phone system? Do your insureds have forklifts or front-end loaders or even storage trailers in the back? All this property is in 100 feet of premises and is covered in the building's personal property form, or is it covered in a marine? Because often we cover the computer with the EDP program, the phone system EDP program, a forklift with a separate equipment, such as a front-end loader. The storage trailer we might not want covered at all, depending on where it has wheels or not. All those things within 100 feet of premises. And typically when you look at an insured's location, you cover those items in a separate inland marine product. And let's talk about how those things work together. Property not covered is what we look at. When it says property not covered, it says it's not covered under business and personal property form. Therefore, it does not have to be included in the limit. There are two areas that you want to look at that a motor carrier might have. Property not covered under 2K. Property that's covered under another coverage form of this or another policy in which it is more specifically described except for excess of the amount due, whether you can collect it or not from the other insurance. What we're talking about here for other insurance is your inland marine forms. So what this says here, if you write an EDP policy, if you write a cargo policy, you look at that first, and then if you need more coverage beyond that, then you can look at the CPP, business and business personal property form. Also, we deal with the vehicles that your insured has. Vehicles or self-propelled machinery are not property. So those mean that the trucks, the trailers that are licensed are not covered property. Therefore, that storage trailer would not be covered if it was still licensed and still have ability to travel on the road. However, if it's on blocks or if it's not licensed anymore, then it would be covered or could be covered under business personal property. Let's talk about where there is an overlap in this and where we have this consideration. You're looking at insurance premises. Let's talk about that cargo inside those trucks sitting by the fence that is involved in my beer company. The cargo form that you have there would address the cargo in those vehicles sitting by the fences. But most cargo forms, as you know, have a statement that says we'll pay $100,000 per vehicle, but no more than 2 or 3 or a catastrophic limit. Let's say it's 2 times. Let's say in the case of beer, we would not need $100,000. Beer is very useful, but the price of beer is not that high. Let's say the coverage of the beer is $20,000, and we have those vehicles. We have 40 vehicles sitting by the fence. Let's say a hurricane comes or a tornado comes or the building catches on fire, damaging the property outside, or even vandalism or theft. What we would do is collect the $20,000 ×2 on the cargo form, but then the other beyond 2, meaning we hit the cat limit, we have had the max we'll pay for any one loss, would be that we'll take the rest of it back on the CPP form in excess. And by doing that, since it doesn't have to be a limit, it's not subject to co-insurance, and therefore it will not, we might not pay a premium for it. The same thing with your computer systems, your electrical data processing systems. If you write a separate computer policy and you look at all those terminals, you look at the receivers, you look at the items involving the computer system, you would collect what the EDP policies would pay and collect the difference between there, if you need it, from the furniture and fixtures, not the software, but the furniture and fixtures, the terminals, the screens, the service, those things. You would then collect the excess in the CPP policy. This is a trick that some people might not think about, and I talk about this when I teach this class in other arenas here. Let's say you have a forklift. Let's say you insure the forklift on a contract equipment policy, which in most cases will be ACV. If that forklift is used solely on the insured's premises, then it also qualifies as coverage under machinery and equipment. If it's used off premises, it's not. We're only talking about on premises. That if it never leaves the premises as operation on premises, then you would collect ACV from the inland marine, and you would collect the difference between ACV and replacement costs on the CPP policies. So that's how things would work together. And this is where, again, the first introduction is how to cover it when you have exposures where it can be both covered in the marine form as well as business personal property. What the form says, the building and business personal property form that we write to cover standard property coverages for our insureds, say that you look at the policy that covers the items more specifically: contract equipment, cargo, EDP, see what you collect there, and if you need any additional beyond that, then you can look at the CP form. There is a consideration. You must have enough limits, meaning that if it's a total loss and you have not considered those things, then you would not have payment because there's no more than the limits. It'd be subject to the cause of loss and also subject to a deductible, obviously. So in the case of the contract equipment, you would have possibly two deductibles that we mentioned, and the same thing as cargo. But if property not covered, it does not have to be in the limit, and it's not a part of co-insurance consideration. So when loss happens, you look at both policies, the CPP or the marine, and then to the other one for meeting the additional coverage for those gray areas. You have other marine exposures that you might need to consider. That, again, location, we mentioned the forklift, the equipment used on premises only. CPP or equipment policy would how you address that. But accounts receivable, value of papers, signs, EDP, Bailey coverage. Later we're going to tell you that in the marine policy, again, even cargo is a Bailey coverage if you insure have warehousing exposure. Plus you got the property in transit, which is the cargo form, which most of you all write and most of you all have interest in, that we'll get through as we examine these things. So you look at, the other thing you need to look at is most CPP policies that I see, most commercial practice policies I see, have an extensions of coverage. Typically those extensions of coverages will cover some off-premise coverage, some Bailey coverage, some computer coverage, some sign coverage, some value of papers coverage, some accounts receivable coverage. So when you look at the overall property coverage that you're providing insured, you look at the basic CPP policy. Then you look at the insurance carrier's extensions of coverages to determine what they're providing for you in the basic cost in the CPP policy, and look at the things there that are traditionally covered in marine to see what kind of coverage that you already have and that you're paying for in the CPP, and then buy the difference. I have a case that I'm involved in here where the extension of coverages that we have with our insurance is $100,000 in the extension of coverage in the CPP form. Their computer systems are worth more than $100,000. But we have the $100,000 in extension of coverage, so we then cover the first $100,000 in the extension of coverage because it's covered property, and then we have another $150,000 under the EDP policy to cover both the hardware and also the software involved in that. You would look at the extension of coverage first before you would get to the to the inland marine, and your marine policy will say that you would look at it that way too. So you got to look at these things together, not in a vacuum, but together. There are some endorsements that you might want to look at: debris removal, pollution cleanup, ordinance of law, additional covered property. Here, if your insurers have a dynamo, or maybe a training equipment that they have that cannot be moved easily, presses and things in garage areas, you might ask your carrier to add the additional covered, additional building property there, so that you would get the building rate versus the personal property rate. Additional property not covered, that's where you would add that endorsement to take care of the property outside the premises, the stuff in the boneyard, lease property, and then you can separate limits, again, the boneyard versus what's inside the building. So these endorsements, if you do write the personal property, you need to be familiar with. One of the things I do find, particularly if I'm talking to people in this presentation that are with wholesalers and insurance companies, most of you all have facilities to write some of the property coverage, but often we only look at what we consider the trucking exposure, and we don't attempt to write the property coverage too. I strongly recommend, as a retail agent and as a wholesaler, to try to offer both the coverage. The more policies that the insured buys from one source, the stronger the relationship and the longer the retention. The endorsements consideration, you would want to write it replacement cost, not ACV, but the value of the property must be at the replacement cost value. How the payment works, this is kind of confusing here, because they say we'll pay it at ACV, then once you prove that you have spent the money, meaning that toolbox that we have covered that's in that shop, what we would first get paid for is ACV, but once we then take that money and go buy new tools and then give the insurance company the receipt of when we bought it, then we collect the difference between ACV and replacement costs. This is the moral hazard. The insurance carriers do not want the insured to better themselves, meaning to get more than the property whose damage is worth. So what they say is, we'll pay you ACV, which is what your financial interest is in the property, and once you spend that money, then therefore have the equipment now to go back to work, meaning that you did spend the money, then we'll pay the difference between replacement costs and ACV. Agreed amount is, it's not a payment guarantee. It clears up the co-insurance obligation up front. Strongly recommend that. Insurance carriers who are dealing with this, or wholesalers, don't be afraid for this, because you get an extra 5% for doing that part of it, and that's worthwhile, and to not have a dispute later about co-insurance. And again, we mentioned blanket would help. Again, both of the agreed amount and the blanket coverage, the insured has to file a statement of values, which has input from wholesalers, from the insurance market, to make sure those values are correct. We also had the business income and extra expense coverage. Business income, loss of income because the building has been damaged and cannot be used. There's an extra expense, payment to be kept in the business, to keep it in business because of the damage to the property, not covered location. It's not subject to co-insurance. So this is the extra expense to stay in business versus the location. You have a lot of insureds that are location dependent, meaning where the 7-Eleven store is, or the general dollar store, or Sears and Roebuck, that's dependent on the location. But in trucking, in most cases, we don't care about the location, so therefore we don't lose income. What the insured looks for is how to stay in business, how to rent another facility, how to expedite or lease more property or lease equipment to replace it. Let me ask you a teaser, and this would be something that would be interesting to test questions about this is, do or could your insured have trucks parked at their location within 100 feet of premises? Could the trucks be damaged by a covered cause of loss? Tornado, hurricane, fire, vandalism. Would this cause a business interruption cost, meaning those trucks cannot be used because they have been damaged, therefore your insured has suspension of operations because they don't have equipment to be used? Where's their coverage? Here's wording that most people don't understand in this form that you would want to look at, and then you can go back and write this. And we're talking about the business income and extra expense coverage form. This page for the business income means the net income and the cost to continue the normal operation expenses, including payroll. That's the sniffing part here. But let's talk about on the next page what is a covered property. We will pay all actual loss of the business income you sustain due. This also includes extra expenses due to the necessity, suspension of your operation during the period of restoration, meaning until you can properly get back because you repaired it. This suspension must be caused by a direct loss or damage to property. Key word here, folks, it's not covered property. Those trucks outside, the trailers outside the fence, sitting there, being ready to be used, even though they're used off premises, even though they're not covered property on the CPP form, they're still property. So you can collect the rental reimbursement, cut the costs for your insurer to go out and replace those units as they are repaired or as they are replaced under the physical damage coverage. This is not going to cover damage to the equipment itself, just the loss of use of that equipment until it can be replaced in the physical damage coverage. So when you look at this business income and extra expense, you need to factor in those kind of exposure too. Again, depending on your insurance operation, getting back to looking at Google Earth, are the parking facilities there? Does the insurer bring their equipment in at any given time and park them in that terminal or at that location or not? So that's a concern that you would have to also coordinate the loss of earnings or business interruption coverage that you might have. When you set the form up, again, you need to have more detail than just this quick overview of this coverage form, that there is a co-insurance provision in it, and we worry about that, but it only does with the loss of income. It does, the co-insurance factor is not a consideration in the extra expense costs. So even though there's a co-insurance penalty from the loss of earnings due to the location, which in trucking, that's not what our exposure is. Our exposure is the need for the extra expense to keep operations. Those dollars will not be subject to any kind of co-insurance. So we need to walk through those things as we think about these areas before we move into the coverage we're going to spend more time on in these 4 hours now, 3.5 hours left. So, business income and extra expense coverage form addresses damage to property, not covered property. Are these units parked within 100 feet of premises? Are units property? Answer to those questions is yes. Then the business income and extra expense coverage form will pay to rent replacement units. So, coverage form recap. Commercial package policy, standard form we write, CPP, property within 100 feet of described premise. You need to check the ownership to make sure the owners of the properties are properly covered. The term we use often here, as their interests may appear, which means that if we have the motor carrier who has responsibility under the triple lease to cover the building and the personal property that also have there, and the building and the alterations to give to the building, then you would have both the motor carrier, your insured on the policy as an insured, and you would have the trust or the landlord as their interests may appear also named insured on the policy. And when a loss happens, we would pay the person who has entitled those property. Property covered under another form, look at in the marine if there's not enough coverage in the business and personal property form. That would be, again, your EDP, could be cargo, could be equipment. And then you look at extra expense. Off-premise coverage in the CPP form is not adequate enough for us. It's only $10,000 but that's not in transit. The coverage in transit is limited to $5,000, very limited, and only if you write the special loss. So the biggest concern that we have from the business that we write as motor carriers insurers is the business personal property or the property of others that's in our insurance carrier control off the premises. That's the key here. This form is premise location. It's needed because insurers are hauling property. This is a consideration. The property of others, private. The standard commercial package policy that we write only cover property with 100 feet of premises. Does not have coverage form with enough transportation in the extension of coverage. So it's needed because insured also holds property of others. That's the two exposures you have. I have my own property or I have property of others. This is our typical insured. This is a for-hire trucker. They would need this coverage to protect their legal liability because they would be have to take care of the property as a person, could be responsible if the property gets damaged while in their care control. So we buy back that responsibility. That responsibility is a bailee responsibility. Bailment means I have property of others in my possession to do something with it. I don't take title to it, but I process it or do something with it, and therefore I return it or take it to the consignee or return it to the insured in the same condition that I received it. Again, those are the marine forms that we'll be talking about in this discussion later on. Coverage consideration for owners of property being transported. They need it because others are hauling their property. Recovery not easy. Enough dollars are direct. What we're talking about now is your insureds are shipping their goods by a for-hire method of transportation. Trucking company, rail line, airlines, some others. They could be a marina checking. They could be Amazon delivering things, UPS. You have a lot of insureds doing that. They would be concerned about recovering that property while it is being transported by somebody else. And so they want to have enough dollars there to cover their assets and to cover their exposure. The other reason is, again, is for financial security of the insured. That's the same reason that any private carrier insures a building, personal property. Most of the times in the for-hire trucking arena, the shipper puts the requirements of limits and what's recovered. And there could be some requirements for regulatory authority, mainly if you're involved in moving and storage, then there's some requirements of coverage at the federal level for moving and storage companies involved in interstate commerce. To address both the EDP, the equipment coverage, and the bay lease coverage and the off-premise coverages, we would use inland marine coverage for. The commercial package policy is premise location. And marine is not. But when we think about the term marine, when you hear the term, what comes to mind? Most often when we do this, we think of water. We think of wet here. So what type of coverage do you think when you hear the term inland marine? The things we just talked about, EDP, cargo, and the arena that we deal with. The main exposure in marine addresses and why does the insurer need an marine coverage form is because of property off-premise. So that's the big concern. Some of us are old enough to remember some of these marine policies were called floaters. Again, that's the big distinction. The CPP policy derives all coverage from the location that is shown on the deck sheet. And marine policies provide coverage for property away from that location without a described location. We describe the property and we cover the property wherever it's damaged, either as a bailee or owner of that property. This is an old line of insurance. Inland marine has been around for a long time. Most by reputation, it started in the London situations where we had the coffee shop at Lloyd's that started the sea captains deciding how to share exposures, and that was the original development of ocean marine. Once it got to the land, it still needed to be covered, and that's where inland marine came from that derivative there. I made a comment when I teach this openly here, is that London situation I just mentioned from the old days had two flaws. First off, it was a coffee shop, but I understand they sold more than coffee there, and second, they didn't allow any females in that shop, so therefore they couldn't get it right. So anyway, that's where we come with the London product here. The type of property that inland marine typically address is while property is in transit. That's our exposure for cargo. It also covers mobile equipment. That would be the forklifts that your insureds are carrying with them on the back of the flatbed truck to be used to load and unload at a location if that forklift gets damaged. It could be your land clear who takes the front end loader or the bulldozer with them to clear the land as they haul the debris away or haul or spread the dirt they bring to it with their dump truck. Those are the things, the equipment itself. Property that's instrumentalities of transportation or communication. You don't get involved in that often, but that's where we cover bridges, TV, satellite dishes, TV towers, cell towers. Those things are involved in it. And any other property that the underwriter is willing to consider here, and one of the ones that we'll talk about here in a few minutes is coverage for physical damage of trucks. So it has some varieties of this. How lines of insurance are written. This is the key part here. Y'all in the location, and most of you all are dealing with in this arena, know the difference between admitted insurance company and non-admitted insurance company. Well, this is also the type of coverage here. If you know, an admitted insurance company must file their coverage forms and their rates with the insurance department, and they must use those rates and those coverage forms. The CPP policy is a controlled line of insurance, which falls on the admitted cargo. However, most inland marine coverages do not have that same restriction as far as coverage forms to be filed or at least to be approved by the Department of Insurance, and or the rates are not as filed and has to be approved by the Department of Insurance. You need to check that. That varies by states, but typically inland marine is an uncontrolled line of insurance. There's no limit or limitation for the regulatory control on the insurance company's forms, So that's the big difference here. And the big key here is that in the marine, the forms have far more differences in wording and coverage differences than you would have in the typical CPP or typical property coverage, again, because of the state oversight of forms and regs and rules similar to the admitted marketplace. So what is in marine? You look at the package versus a marine. What's to cover? You need the transportation, property used away from insurance premises, there are fewer exposures. The pricing could be different in some cases because we'll talk about later the difference in pricing say a crane on a business auto policy or an auto policy. That rate might be 4 or 5% because that's what we get versus an marine rate, which might be $1.25. We'll talk about those differences here. You got to find out what your carriers will write as far as in marine, and then also always check the enhancement of the CPP policy before you look at providing in marine coverage. So before we review the property and transit exposure, there is property away from the premise that needs to be addressed. Power units and trailers. The typical covered on physical damage coverage within the auto coverage form. And the coverage for physical damage says will cover the auto and its equipment. It doesn't say attached equipment. And then we have 3 choices of cause of losses. Comprehensive, which only excludes collision overturn. Specified cause of loss, which lists 6 causes of losses: fire, lightning, theft, windstorm, flood, machinery, and other items in collision, other than collision. Then you buy back collision. Most of you all write in the comprehensive collision form. That's what we typically write today in the marketplace. We also have the problem of the definition of property now, and this was changed in the 06 coverage form, which auto means a land motor vehicles, but second, any land motor vehicle that's subject to compulsory financial responsibility. However, it does not include mobile equipment. So we then see that the mobile equipment does not cover items. So when we look at the physical damage in the auto form, we have the auto as equipment, no requirement to be attached. Watch ISO, non-ISO wording. It could require it to be attached, particularly some of the London products. Insured must prove that items or equipment are covered auto. And if they do, it's covered, like tarps, chains, sideboards, headache racks, snow plows, auxiliary power units, all those equipment of the unit. Comprehensive collision is the closest we have to all risk. It only excludes nuclear contamination, wear and tear, and road damage to tires. That's all that's excluded. So units that the motor carrier has that are mobilized equipment, that are mobile equipment, yet they have to meet financial responsibility requirements, they can be covered or be considered auto. Farm equipment. Florida, we have things called goats. Those are things running around the field that loads the oranges on the back of this mobile equipment or this equipment in the field to take it to a central location within the field to load it to on the tractors and trailers to be hauled away. To move it from field to field, sometimes it runs on the public roads, therefore it's licensed, so that cab and chassis plus the equipment is not mobile equipment, it's auto because it has to be licensed. Some of your insureds are heavy haulers, have cranes, and those are motorized, and they typically would have to be licensed. Flatbed power units with attached unloading devices. We've seen the concrete block unloading devices. We've seen concrete ready mix trucks. We've seen well drilling trucks. All those things have equipment. And a lot of times equipment is worth more than the power unit itself. So if your insurance is a specialty company, if they're in the farming area, if they're in the construction area, they're concrete ready mix, they have cranes, they're heavy haulers. If they do any of those things, the question, or record companies would be, again, same thing. Is it better to cover the auto or inland marine? Both forms cover the power unit and the equipment. So to use an auto form or inland marine, you should write the total unit in one or the other, meaning cover the auto and the equipment. On the auto form, cover the power unit and equipment are auto form on the power unit and the equipment on the marine form. Don't split it. If you split it, you end up with 2 deductibles, 2 cause of losses, in a lot of cases 2 adjusters, 2 different approaches to it. And I contend that in the equipment there is a significant amount of value, whether it's 10% or 15% that are commonly used equipment, hydraulic systems, electrical system, the attachment equipment. So you want to insure it at the best level. So which is the best coverage? Again, depending on what we write limits on, typical physical damage, not in our arena, would be original cost new, but there's no limitation of coverage. We would typically write this kind of equipment on the inland marine and in a special trucking area on a stated amount, where the premium is based on the amount of coverage and is capped by the limit. And so we worry about setting those things up in those areas. The point I'm trying to make here is that never be afraid to write this equipment on the auto forms. The auto forms are broader coverage than any inland marine form that you might have, from original cost new to the cause of losses. The inland marine forms have more exclusions than any auto physical damage form would have. But from a cost standpoint, you probably would write the concrete ready mix company, the crane, some of that equipment on the inland marine form because it's less costly, but it's also less coverage. Some of you also particularly write Lloyd's and the physical damage of your units on the inland marine form. In fact, I'm looking at one now for one of our members here. Again, it's an inland marine form. It has more exclusions in it, so you need to be concerned about that. The one I'm dealing with here is employee theft. Typically, in marine forms have dishonest acts by employees or drivers or other exclusions. The auto form does not. And so that's a major difference in coverage between the two. Right, inland marine and the one we're dealing with here, with alleged the driver could be involved in the stealing of the equipment, then inland marine form would deny coverage where the auto form would not. So look at coverage being provided in the basic property coverage and then address what's not covered there with inland marine. Watch how policies work together. In marine first, then CPP is excess. CPP is location-based in marine coverage property wherever located. And then you want to look at equipment coverage that we talked about, covered on the inland marine or the auto coverage. Next month, in part 2, we'll talk about property of the insureds away from the insured's premises, and again get into more detail as we move into the cargo forms and the transit forms. We hope you got something out of these this first session of the inland marine coverage. I know it was basically starting with all the property coverages first, but you need to start there and as you look at it, because I have always had a philosophy: you cannot write coverage in a vacuum. We hope you have a good month, and we look forward for you participating in part 2 of our Marine CE course. We're out of here.